3 years ago, I watched $30,000 disappear from my account in less than 4 days. Not because the market crashed. Not because I picked a bad stock. It disappeared because of one word I didn't understand, a word my broker used in a notification I didn't even bother to read properly. That word was margin call. By the time I figured out what it meant, my position was already liquidated. Gone. And the worst part? It wasn't even a complicated term. It was sitting right there in every stock market glossary, and I had simply never looked it up. Before getting started, please like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. A stock represents ownership in a company. When you buy a share, you're not just buying a number on a screen, you literally own a small piece of that business. There are two types. Common stock is what most of us buy. It gives you voting rights and a claim on profits, but dividends aren't guaranteed. Preferred stock skips the voting rights but usually pays steadier dividends and gets priority if the company pays out money. Now, when you start owning more than one stock, you have a portfolio, your full collection of investments. Some of those might pay you a dividend, which is just a company sharing its profits directly with you. Here's something I didn't know early on. Not every company is even available to buy. A public company has listed its shares on an exchange. A private company keeps ownership locked with founders or private investors. You can't just call up SpaceX and buy shares, it's private. To track how stocks are performing as a group, we use an index, a basket of stocks representing a slice of the market. The S&P 500 tracks the 500 biggest U.S. companies. The Nasdaq leans tech-heavy. The Russell 2000 tracks smaller companies. When people say they want to beat the market, they usually mean beating the S&P 500, and that's brutally hard. Most professional fund managers don't even manage it consistently. If you are getting valuable information, so don't forget to like the video and subscribe to channel. Where I actually lost the money. Now here's where my story gets relevant. I was trading on margin, meaning I borrowed money from my brokerage to buy more stock than I could actually afford with my own cash. This amplifies gains. It also amplifies losses, brutally. When the stock I bought dropped, my account fell below the minimum required balance. That triggers something called a margin call. Your broker demanding you deposit more money immediately, or they'll force sell your position to cover the loan. I didn't respond in time. They liquidated my position automatically. $30,000, gone, in a forced sale at the worst possible price. This is connected to leverage, using borrowed money to increase your buying power. It's also connected to liquidity, how easily a stock can be bought or sold without moving its price. My stock was a smaller, less liquid one, which meant the forced sale tanked the price even further on the way out. Double damage. If I had simply understood these three terms, margin, margin call, and liquidity, before trading, I would still have that money today. Let's cover the mechanical side of the market so you're never caught off guard like I was. Stocks trade on a stock exchange, the marketplace where buying and selling happens, the biggest being the New York Stock Exchange. You access it through a brokerage, which may charge a commission for each trade. Every stock has a short code called a ticker symbol, Apple for Apple, TSLA for Tesla. Trading happens during official market hours, typically 9:30 a.m. to 4 p.m. Eastern Time. The opening price is where it starts the day, the closing price is where it ends. Outside those hours, you have pre-market and after-hours trading, useful for reacting to news, but with lower volume, how many shares are trading, and lower liquidity, meaning prices can swing wildly on thin activity. This is exactly the kind of environment that gets beginners, including past me, into trouble. This next section is the one most beginners skip, and it's probably the most important. Market capitalization is the total value of a company, stock price multiplied by total shares. Enterprise value goes further, factoring in debt and cash for a fuller picture. Revenue is total sales income. Subtract expenses, and you get net income, the actual profit. On a balance sheet, assets are what a company owns, liabilities are what it owes. To compare companies, investors use earnings per share, EPS, profit divided by total shares. From there, the price to earnings, P/E ratio tells you if a stock is expensive or cheap relative to its profits. The PEG ratio adjusts that for expected growth. Dividend yield measures dividend income relative to price. Free cash flow is what's left after expenses and investments, the real fuel for dividends, buybacks, and growth. And then margins, gross margin, operating margin, and net profit margin, each one strips away more costs to show you the true bottom line. Stocks come in flavors. Growth stocks reinvest profits to expand fast, think tech. Value stocks look cheap relative to fundamentals, betting the market will eventually notice. Blue chip stocks are large, stable, reputable companies. Cyclical stocks move with the economy, airlines, automakers. Defensive stocks hold steady regardless, utilities, healthcare, essentials. By size, large cap, over $10 billion, mid cap, $2 to $10 billion, small cap, under $2 billion, and penny stocks. Cheap, volatile, and exactly the kind of thing that should make you nervous if you're a beginner. For diversified exposure, there's mutual funds, professionally managed, pooled money, ETFs, trade like stocks, often track an index, and index funds, which simply aim to match the market rather than beat it, a strategy that, ironically, outperforms most people who try to be clever. Then there's hedge funds using advanced strategies like short selling or leverage. Volatility measures how much prices swing. The VIX, the Fear Index, tracks expected volatility in the S&P 500. A bull market is a sustained rise, optimism-driven. A bear market is the opposite, falling prices, dominant pessimism. A correction is a pullback of roughly 10% from recent highs. A rally is a sharp climb after a dip. A crash is a severe, sudden drop, often panic-driven. A bubble forms when prices rise far beyond actual value, and bubbles always, eventually, burst. Market sentiment, how investors feel collectively, can move prices more than company fundamentals in the short term. This is exactly what happened during my forced liquidation. It wasn't really about the company's fundamentals. It was about a margin requirement and panic-driven price action. Passive investing means buying a broad index and holding, without picking individual winners. Dollar cost averaging, DCA, means investing a fixed amount regularly, smoothing out market swings. Lump sum investing puts a large amount in at once, faster growth potential, but riskier timing. Active investing means picking stocks or timing the market to try to beat average returns. Tactics here include buying the dip, buy and hold, and market timing. Which is exactly as difficult as it sounds, even for professionals. Deeper approaches, fundamental analysis studies financial health and industry position. Technical analysis studies price charts and patterns. Macro analysis looks at the broader economy, interest rates, inflation, global trends. And then there's speculation, high-risk bets on big gains. If I'm honest with myself, what I was doing wasn't investing. It was speculation, dressed up as a strategy, funded by borrowed money. That combination is exactly how beginners lose savings fast. The terms that actually save you money. This is the section that matters most, because these are the terms that protect you. Diversification spreads your money across different stocks and sectors so one bad position doesn't sink everything. Asset allocation divides your money across stocks, bonds, and cash based on your goals and risk tolerance. Rebalancing keeps that allocation on track over time. To measure your risk-adjusted performance, alpha shows whether you're beating the market, beta shows your sensitivity to market swings, and the Sharpe ratio shows return earned per unit of risk taken. Higher is better. Understand two types of risk. Systematic risk affects the whole market, recessions, rate changes, and can't really be diversified away. Unsystematic risk is specific to one company or sector, and diversification does reduce it. If I had simply diversified instead of concentrating one leveraged position into a single stock, a single bad week wouldn't have wiped out $30,000. It would have been a minor dent. The macro picture. Zoom out, and the wider economy shapes everything. Inflation means prices rising over time, eroding purchasing power. Deflation is the opposite. Stagflation is the rare, painful combination of rising prices with stalled growth. A recession is sustained economic contraction, often measured by falling GDP. Governments and central banks respond with monetary policy, interest rate and money supply changes by central banks, and fiscal policy, government spending and tax decisions. Both ripple directly into stock prices, often in ways beginners don't connect until it's too late. If you enjoyed this video, please give it a like, subscribe to the channel.